I didn't get into real estate because I was focusing on where to invest my money.
The single reason why Zach and I have been able to scale to the level that we've scaled. We've both used home lines of credit on multiple occasions, on multiple properties.
I never looked at partnership as a marriage. I looked at partnership as dating. At 18 years old, my parents notified me that they filed for bankruptcy.
Because there's one main reason why businesses fail: run out of cash.
If I throw a deal in your face and you can't tell me whether it's good or not without going to have to use your spreadsheet, you're screwed.
Hey guys, Enis here, Whiteacre Properties. Welcome back to another meetup interview. Today I have two local real estate investors. They have come to the meetup for a long time and participated. Now they are guest speakers at the meetup. Before heading out there though, I had them here at the office. We just had a good interview because I wanted to have Andrew Freed and Zach Gray talk about their growth in real estate investing. These are buy and hold investors. Now they are up to 100 plus units and they've been only doing this for 3 years. So I'm thinking like, how are these guys doing it? We have really high prices here, high interest rates, and then still these guys are buying. So we sat down, I had a bunch of questions for them. We went over their struggles because growing fast, obviously it comes with a set of challenges. So we talked about the good, we talked about the bad, and I have a lot of golden nuggets for you guys. Let's jump into the interview with Zach Gray and Andrew Freed, talk about buy and hold investing here in Massachusetts. Looking forward to having you guys here and looking forward to having you at the meetup because obviously we got to know each other. You guys been regular at the meetups and I'm seeing the growth from everything you guys are posting and everything you're buying and selling. And a lot of people want to get into a real estate game and they struggle, right? So I wanted to break your business apart a little bit and see if we can share with anybody watching what's working, what's not working, right? Before pressing start here, we were talking about struggles. I think I personally find a lot more value in struggles because that's where we learn more. So we'll keep it real. You guys are local to the market. Let's actually start briefly. Who are you? How long you been in real estate investing? Really quick, and then we'll jump into some questions I have for you guys so we can go deep into the business.
So I've been in real estate for a long time, an entire 3 years. Started during COVID. Read Rich Dad, Poor Dad. He locked my one-bedroom condo. Arbitraged that into buying about 30 units with myself and JV partners. And then at that point, I ran out of money and I had all these amazing deals coming our way. And we figured out how to raise capital from investors and start buying larger deals. Today, Zach and myself, we're up to about 150 units and we have, I think, somewhere close to around 100 units under contract.
That's awesome, man.
Yeah.
Cool. Zach, yeah. What about you, man?
So I've been in real estate since October of 2021. So I'm actually less than 3 years. What I will say is that I got into real estate in sort of like a non-traditional way. I didn't get into real estate because I was seeking passive revenue. I didn't get into real estate because I was focusing on where to invest my money. What I actually was trying to do is I was trying to mitigate my biggest expense during a volatile time that was COVID as a means to try to provide more financial flexibility to scale my own business as an entrepreneur, which I did through selling a townhouse that I lived in, mitigating my biggest expense, and then effectively buying my first multifamily. My intention was to buy like a multifamily a year. I started listening to Bigger Pockets. During COVID, I was actually driving around house to house doing personal training. So I had a lot of travel time to, in basically out towards Boston and then driving around house to house all day during that time. So I had a lot of education hours through Bigger Pockets. And effectively, it just sort of transpired into me kind of soaking up a lot of information, getting really inquisitive about sort of some of the info that I was obtaining, and then starting to theorize ways in which I could practically apply it. And to which I started going to, real estate-based meetups. I met this guy, and our partnership was as simplistic as he calls me up on a Friday night with a deal that he thought was great that he didn't have enough capital to do, and within probably 5 minutes on the phone, I said, "Send it. Let's submit an offer." It was really just sort of sporadic, but I think what it comes down to, and the takeaway is like action taking is what yields results. And like, I could not stand by that statement anymore. And I think that we still continue to beat that same drum today. Yeah. And that's really what has yielded the success that we have been able to have in such a short period of time. Yeah. Because I think that the two of us, we're like a yin yang in terms of our strengths. Yeah. But I think that the commonality that we share is that we're really passionate action takers.
That's awesome. So most people, obviously, the takeaway there is also come to the meetups, right? So that's where these relationships get built and businesses start. But that Friday night call, and you said, yes, let's submit an offer. How did you even know he's the right partner, right? 'Cause a lot of people want to do this on their own, right? It's nerve-wracking to say yes to somebody else coming in as 50% partner.
I never looked at partnership as a marriage. I looked at partnership as dating. I essentially said, hey, I had enough intel on the market in which the deal was being proposed to be able to make an informed decision. Yeah. I felt like the deal was good. So I was more focused on the actual deal itself. Yeah. And then I felt like, hey, if I'm buying a good deal, I'm going to make money regardless. I trust my own skill in being able to operate and navigate, some of the challenges to achieve success in this operation. Yeah. And throughout this process, it will be a trial and error, tribulation to be able to determine, is this a good fit? And if it's not a good fit, then it's an opportunity in which I made some money, he made some money, and we can go our separate ways. Right. But I think that, again, if you're focused on trying to find the perfect deal, the perfect partner, the perfect, it's like the perfect split with investors. Like you're spending too much time worrying about ancillary things that won't really yield like outcomes and that's what we're all after, right? Yeah, exactly.
Andrew, same question to you, right? Because how were you looking at it? Because same thing, right? Now you're just jumping into a deal with somebody. You don't know if in 2 weeks he'll be like, you know what, I'm out, or in 2 weeks he'll be like, I can do this type of project the way you're running, and now you get conflict, and how do you deal with that on your first deal or second deal? So what was the mindset there?
I've started businesses in the past and they were failed businesses. And I've come to realize that a lot of times you want to do business with people who are similar to you, and that doesn't really serve you, right? So when I was really thinking of partners, I was thinking, who really makes up my weaknesses and who really likes doing what I don't like doing? And I like to sit in my genius, which is kind of process oriented, is kind of in back-end paperwork, is being kind of the face of the organization. Yeah. And he very much makes up my weaknesses in the fact that he's really good with, tenant communications, with CapEx, with contractor relations, with getting stuff done, like boots on the ground. So when I thought about this partnership, I thought, okay, who can make up my weaknesses? And Zach was the first person to come to mind. And literally, it wasn't even 5 minutes. It was a 45-second conversation. He was like, I'm game to throw $80K in this deal. Didn't even look at the deal. Just like went right off my word. And to be frank, that was honestly one of our best deals. And with that deal alone, we've created over probably $400,000, $500,000 of net worth through that deal by arbitraging that money into other deals.
Okay, since you guys talked quite a bit about this, and I didn't want to go into that deal per se, but it's piquing my interest. First of all, you probably had the experience as far as running numbers on multiple deals before that, right? To say, yes, this is the one, let's submit an offer at this number. But let either one of you guys, if you don't mind going over what the numbers look like, how was that negotiating process? Let's just talk about price, financing, any of that stuff.
What I will say is that it was not smooth front to back, to say the least. And he's laughing because he knows what I'm about to say.
I know exactly.
Which is, the deal is, it was a 5-unit property that was right on the MLS. Okay. It was put on a Friday night. Okay. Only junkies are scaling the MLS at 6 p.m. on a Friday. So, right? So when I get a phone call at 6 p.m. on a Friday, I actually remember exactly where I was. I was walking my dog in the woods in Hudson, Berlin area. He calls me up and he says, hey, I got this deal in Worcester, $130K a unit. And I'm like, how big are the units? And I knew that Worcester was like, 150-ish, 155 to 60K a unit at the time. And I said, okay. so how big are the units? And he's like, well, 3 beds, 2 1-beds. And I was like, sold, I'm in. And he was like, what are you talking about? I'm like, what's the condition, blah, blah, blah. And he was like, well, we can set up a showing. We can walk it next Tuesday. This is the plan. And I said, great, let's walk it. Let's submit an offer. And he was like, let's get it under contract and let's move. And he was like, okay. And he like anticipated it being like this whole like elongated pitch and like trying to talk me into it. And I was like, no, send it. It's exactly what I'm looking for.
But your confidence was based on, again, looking
Predetermined
at
knowledge, 100%. Yeah. And so like I already knew what I could rent the units for. I relatively knew the area. I had a good feel. I also went to college in Worcester, so like I was familiar with Worcester as a whole. So like there's a whole number of things that kind of precluded that resulted in me feeling confident in the actual deal itself. What I will say is that like also as like a precursor, like I'm an extremely sort of like shoot first, aim later kind of person. Like just for like as a backstory, just very short, like I went and met with a military recruiter on a Monday and then enlisted on a Friday. Like that's just like
that's
who
how
I am, right?
That's how. Got it.
So I think that like it's like when I'm decisive on something and I know I want to take action on something, it's like let's make moves. I'm not looking to like, procrastinate or like perseverate over minutia, right? Yeah. So, but getting back into the deal, effectively priced at $650 for 5 units in Worcester. The current rent roll on the property was $3,700.
Wow.
Yeah. We went and walked the property. Yeah. We had the first showing on a Tuesday, and they had like 8 showings after us. Okay. We walked the property, him and I on the curb, literally in front of the broker, went back and forth about our feelings on it. And we had already submitted a blind offer. And, we basically just said to the broker, our offer is good, send it. Call the seller right now. I was like, we want this locked up before those other 8 people get here. Okay. And so
you guys offered over asking?
List. We just offered list inspection information only. I mean, if it's a good deal, why haggle over 10, 20K? Okay.
And so we ended up getting the property under contract. I think the point that he was laughing at earlier was that we went through the whole due diligence period. We kind of navigated the whole closing process. And we got great loan terms. And within about 10 to 14 days before close, our lender came back to us and said, hey, instead of 20% down, you guys have to put 25% down. And, we're like novices. And also it's like we had already exhausted our own capital to the point where we needed each other to do this deal. So it's not like we had buckets of money lying around. So I think that I got very frustrated over this. I basically just popped off on the lender.
What did that look like?
It did not go well. So Andrew played good cop in the scenario.
I'm happy for that.
Kind of walked the situation back. But needless to say, the funniest part about this entire story is that specific lender is now like our number one go-to lender.
Yep.
And is literally single-handedly has played a major role in our successes in scaling our business. Because effectively, I think he took a little bit of a chance on us. Right. And then I think as we continue to scale, we continue to prove him right, which worked well for him. And it's like we helped each other. Yeah. So I just think it's kind of a funny, ironic outcome. But it definitely makes for a great first partnership and story together. And I also think that like, we're less than 30 days into the situation and he's probably thinking to himself like, what did I get myself into?
This was not a good idea. Yeah.
No, and I just want to add that, but I thought you were going to talk about a different story where we were trying to do a rent raise on one of our tenants, and they called the cops on us, and I almost got arrested for that. So I thought that was the story you got to talk about.
And not a rent raise, called the cops. But he also forgot to mention that she chased him down the hall with a frying pan.
Well, so just if you don't mind me, just let's walk through that real quick. How much were they paying? How much did you go in asking for? Right, like
the best part is it's Section 8.
Yes, right. It was Section 8, but she had a 1-bedroom voucher and a 3-bed unit.
Okay.
So we had, we had no option but to ask her to leave, and she was there for 30 plus years at that point. And I believe her daughter-in-law was on the first floor, so she was very vested in this place. So more or less, she was not happy with the rent raise, and she called the cops on me. And, they essentially took her side. I just called my attorney, let them do their thing.
Right.
And
Yeah, that's not a police matter by any means.
But I think that, Zach brought up a lot of good points. I just want to mention, one of the main challenges with this deal was we bought it at such a low revenue of $3,500, right? So that brings up the point where it's like the debt service coverage ratio for a commercial property has to make sense for the bank to loan you 25% of the property, 25% of the property. That wasn't the case with this. But thankfully, we have mentors on our side that advise us how to get over this hurdle. And what they advised us and what we utilized was construction money. Because when you build in construction money, and we asked for a $50,000 construction loan, they actually take pro forma rents into account after repair value. So because we asked for $50,000 construction money, they took the pro forma rents of $8,500 into account, allowing us only to bring 25% down.
Got it. If actually you didn't ask for construction funds, that would have been a lot worse.
Wouldn't have worked, or we would have to bring 50% down, which we couldn't do at that time.
Moving forward and all the deals you guys did since then, are you always looking for construction funds?
Almost always.
Yes.
And I think that, a completely separate topic relative to construction funding is that hypothetically, what is the standard preferred return that you're paying an investor who comes into a deal with you? And the answer is presumably somewhere between 7 and 9%, I would assume. So if you're paying a 7 to 9% preferred return, that's effectively interest that you're paying on investor capital. Versus what is the going rate for interest from a bank? Okay. So there's two elements at play here. One is money from the bank is far cheaper than 7 to 9%. By funding renovation money from the bank versus from investor funding, you're actually going to, one, improve your returns, but two, the other piece here is that as I've never had a bank come to me and say, hey, you're asking me for construction money, can I get an equity cut in the deal? If I have to raise money from an investor, I have to equity stake them in the deal. So not only am I paying them higher interest, I'm also paying them an equity portion of the deal. Versus if I can get the funding from the bank, well, now we as operators can keep a larger percentage of the deal because we're raising less capital. So inherently, it creates an outcome here where you can create better returns for your investors. You can keep more of the deal as an operator. You can create more flexible lending terms surrounding debt service coverage ratio, right? And the last piece, which we haven't even talked about, is your ability to actually stabilize the asset more aggressively because you're able to tap into that renovation funding capacity to be able to facilitate unit turns or renovation scope, right, in order to execute your business plan in a much more aggressive time frame.
For people watching that actually don't know what preferred return means or how you calculate it, briefly, you said 7 to 9, but what does that look like? How is that?
Sure. So the way that we look at it is take whatever you're calculating as your cash on cash return for the prospective deal. You're basing the cash on cash return off of the total capital included in the deal. So the total capital included in the deal is some combination of investor funds and your funds that you are contributing as an operator. Right. So let's for a second assume that all the funds are coming from investors. So the total return is predicated on the total capital, right? So whatever the cash on cash return is, you're going to have to pay a rate of return to your investors, or you're going to have to propose what you think would be possible for that specific deal to be able to return to the investor. So we normally try to target, and what's standard to kind of be, alluring to an investor is somewhere between a 7 to 9% return on their money. That return is paid for out of the presumed cash on cash returns,
Andrew, when you guys got that call or email or whatever happened there, that they said, hey, you got to put 25% down, how did you guys navigate that? Like, where did the money come from at that point, right? You were probably tapped out. Like, we didn't, you had all your savings into this deal.
We were running thin.
We were definitely running thin. My down payment, I can't speak for Zach. My down payment came from lines of credit. And that's pretty much what I've used to scale. I pretty much used the concept that Zach mentioned where I'm borrowing at one rate and transitioning to an asset that provides a higher return. That's the same with with utilizing investor money and preferred returns, right? Like you're giving them an 8% preferred return, you're transitioning that into an opportunity that gives you a 10 to 12% cash on cash return. You make the spread. That's exactly correct. Same with flipping. You borrow at 11, 12, you get a 25% cash on cash return, you collect the spread. And that's exactly what I did in that sort of situation. I think Zach's cash position was a little tighter than mine, so I don't know what he did with that, but he found the money. That's all that matters.
So
rob the bank or something?
As an 18-year-old kid, growing up, I committed myself to academics in a very, very diligent way. My parents said, anytime that, if you commit yourself to academics, college will be taken care of. At 18 years old, my parents notified me that they filed for bankruptcy. So basically, for me, I have sort of a pre-standing aversion to financial hardship. And in any avenue or any endeavor that I'm sort of, pursuing, going back to the whole prior conversation about scaling my business and trying to mitigate my biggest expense, I'm unwilling to take on an opportunity that puts me at risk of sinking my battleship, right? So I'm not willing to put myself in a position where I cannot smoothly navigate the worst case scenario. Yeah. In this situation, I was pulling money out of a HELOC to be able to utilize for this deal. Okay. And I did have an additional brokerage account of equity, security holdings, okay, right? That I did not want to have to tap into because I wanted to be able to navigate and account for worst case scenario. And my frustration lied with the fact that I was going to have to compromise my value system in order to move forward with this deal. And it was contrary to my belief system. And the other alternative was back out of the deal. And so it was very frustrating. I navigated in an uncomfortable circumstance for, probably, 4 months or so, but we managed to navigate through it. So
you guys both mentioned line of credit. So let's explain to anyone watching this that might be in a similar situation. How do you, first of all, get a line of credit? Where did you get it from? How does that work? So now you're getting those funds and investing it. You can use that example in particular or something else, but just, it'd be good to go over it.
You can get lines of credit from many different forms. They have business lines of credit, which I have a $50,000 unsecured line of credit on one of my LLCs. You can get that when it has 2 years of tax returns and it shows a certain amount of revenue. You can get a home line of credit on your primary residence, normally up to 90 to 100%, or if it's a rental property, you can get a line of credit up to 75% for the equity you have in the deal. Or you could even get a line of credit on a security account, brokerage account. I think Robinhood offers that as well, right? So there's many ways we can borrow against the quote unquote equity that you have in some sort of asset at a set rate of return. So for the lines of credit that I borrowed back during COVID, they were ranging from 3 to 4%. Now, because they're variable, right? They're not fixed, they're variable, right?
Super important for people to understand that.
It's variable. They're up to 7, 8, 9%. Right? But the key there is, like I said, the concept of arbitrage. As long as you're moving 7, 8, 9% of debt into an asset that provides you a higher return, usually a 2, 3, 4% spread, that makes sense to me all day. Yeah. Right? So that's kind of the concept of lines of credit. And that has been the single reason why Zach and I have been able to scale to the level that we've scaled. We've both used home lines of credit on multiple occasions, on multiple properties. And we've maxed them out intentionally, especially during a recessionary period, because what happened in 2008 when people had lines of credit? They pulled them, right? So I would rather have my line of credit drawn use all of that money to buy real estate as opposed to paying $100,000 off my line of credit. If they pull it, then, oh crap, I'm at 100K. I would literally rather have 100K in my bank because there's one main reason why businesses fail: run out of cash, right? So I'd rather be cash heavy, and I think Zach's in a similar situation, and have our lines drawn.
Did it help you guys to have, obviously, you had a full-time job, both of you guys at that point. I'm not sure about now, but you guys always had your W-2 income, right? If someone jumps into real estate investing and they don't have that support, they don't have the W-2 income, can they still do line of credit?
Yes, you think you can get a line of credit on a stock holding. You could also borrow against your 401k, which I've done as well.
Yeah.
Right? So there's multiple options on how to do that for sure.
Yeah, so I think that like banks are a little bit more stringent on debt to income ratios, right? But to his point, mentioning things like retirement accounts, or like hypothetically brokerage accounts, or on a business LLC that you've created, like there's other avenues where they're maybe a little bit less stringent on debt to income ratios of you as a person or an individual that still provide opportunity for you to make use of this tool to scale your portfolio.
Got it.
And I think the most powerful things of lines of credit, and to his point, how it affects your debt to income ratio, interest only. Because lenders only take into account the minimum payment. So if they only take into account the interest only payment and avoid the principal, you're way more lendable. You can actually leverage that debt to income ratio a lot farther.
Analyzing deals, right? You guys jumped into that one because you have analyzed multiple deals before. What does that process look like? And again, all we're covering here, guys, is multifamily buy and hold, right? Correct. For the most part, that's what you guys do, and that's what your niche business is, right? You're focused on buy and hold local here in Massachusetts. I know you're looking in Rhode Island or purchasing in Rhode Island as well, but anyone starting out, like how can they analyze a deal? Like what's the easiest way to say this is a good deal I want to get involved in?
I'll just give a quick synopsis and I'll let Zach go into the details, but more or less it just comes down to a simple calculation. What's the cost per unit, right? And what's the pro forma rents? And where's the delta you can make from that? So say, for example, you pay $100,000 a unit, and you could rent the unit for $1,200, right? That's a 1.2% based off the 1% ratio. It's around 1.2. Like that makes sense all day, right? And also you want to compare the price per unit based off like the area. Is it relative? Like, so the price per unit in Worcester is going to be different than the price per unit in Boston, is going to be different than the price per unit in Springfield, right? So you want to compare it relatively to the average to see if there's built-in equity in that deal where you can utilize that equity in the form of a cash out refinance or a line of credit down the road.
I'll walk it back a little bit too. So I think Andrew brought up a lot of good points there. I think that when I was sort of just starting out and analyzing deals, now, like we don't really use MLS very much or use like apps like Redfin or Zillow to source deals. I think a lot of experienced investors source a lot of stuff off market. But for people who are looking to become more versed in learning how to analyze large quantities of deals, I think that MLS can be a great tool for evaluating deals. And I think that what is important first is for you to be able to take a specific market that you are looking to invest into and being able to determine what various unit sizes rent for. And I think Andrew brought up what is called, what is a pro forma rent for the area. So one of the tools that we use is actually FMR rents, which is fair market rent values, which are determined by the federal government. And you can actually search this website online, through Google, and you can do it zip code by zip code. And it will tell you what the fair market rent value is for a subsidized tenant through programs such as Section 8, RCAP, there's other programs out there like Home Base, but effectively, what does the government deem as the fair value for that unit size in that specific zip code? And we will use that as a tool to calculate what is the possible income for this specific property. And now as time goes along, you start to memorize those amounts. So I know what a 3-bedroom rents for in Worcester. I know what a 2-bedroom rents for in Marlborough. And I can calculate what will be my total gross income. And as you're now, what you'll do is you can draw kind of a radius around a specific town or a specific zip code. And then you can look at all the multifamilies in that specific zip code, and you can look at how many units are there, how many bedrooms are there, what is my prospective rent roll based off of, this formula. And you can now scroll rapid fire through each one, and you can quickly determine what we use as a metric, which Andrew had mentioned, is trying to target the 1% rule, which is effectively the monthly rent roll is equal to or greater than 1% of the proposed purchase price. So if you're going to purchase an asset for $600,000, you need the rent roll to be north of $6,000. So we try to use that as a quick back of the napkin metric when scrolling through vast quantities of deals to determine, is this worth a deeper dive? And so that's sort of like the pre-screen. Then once at this point, once you get really versed with specific zip codes, you can go rapid fire, 5 deals. I could look at 5 deals a second, and I could determine, no, that looks good. No, that looks good. And you can pull them out and then analyze them, in a more sort of concise, detail-oriented process. And I think that what is imperative in the beginning is getting comfortable with that process. Determining, do I know my immediate market in regards to, that I'm looking to invest in regards to pro forma rents? Am I able to use my back of the napkin calculator to be able to sift through vast quantities of deals quickly? Once you become proficient in that, then you can start to focus on the more analytical side, the deep dive side. If I throw a deal in your face and you can't tell me whether it's good or not without going to have to use your spreadsheet, you're screwed, because it's going to take you too long to figure it out.
It makes a lot of sense. You got to be quick, obviously, at just analyzing and saying, where do you spend your time? Where is the highest and best use of your time? But you said pro forma, right? Or are you talking about existing rents?
Pro forma.
Pro forma. We underwrite based off pro forma rents or market rents.
So that 3,700 that you mentioned on that deal that we were discussing, that's just the starting point. You are basing on what you can get that number.
We weren't buying off 3,700.
Yeah, exactly. Well, I mean, the key there is everybody month to month too, right? Because there has to be a path to get it from 3,700 to this case, it was $9,000 within a quick period. Because I'm not going to sit on 3,700 for a year long if they have year leases, right? The only going to I'm not going to be able to pay the mortgage. The overhead's going to kill me. I have to see a path to market within a 6 to 12 month period. So that's how we underwrite. We underwrite based off where we think we can get the units or the properties within a 6 to 12 month period. And added to this point, we also take into account like what's our all-in cost per unit, right? Like say for example, we're getting in for $90K a unit, then it's going to take $15K to stabilize it with vacancy, repair, CapEx, things like that. So we're all in $115,000 a unit. So based off our all-in costs, like where does that compare to the market? Like if the market's $1,400 for that unit, we're all in $115, like that makes sense for us. But if we're all in $115 and the market's $1,000, like that's below the 1% rule. It's literally not even worth us underwriting it.
So I think the key point that he added there is effectively saying it's not just about purchase price relative to rental amount for pro forma to make this 1% rule make sense. You have to factor in existing purchase price plus renovation scope. That is your cost basis. And you are using that as your metric against the rent roll to determine that 1% rule.
And that comes with experience, because once you get started and you see this other cost that that you got, obviously that's real. You have to look at the real cost, right? Everything.
And one thing I would advocate for like people who are beginners, who are like looking to get started, is like you might be able to get really proficient with analyzing price per unit versus pro forma. And hey, this meets 1%, this doesn't, this is north of 1%, this isn't. But you might be really inefficient or unexperienced in regards to underwriting construction costs. And I think one of the things that Andrew and I did really early on was when we would go walk prospective deals that we were interested in acquiring, that we thought would have potential to be good deals, we would actually pay contractors to walk deals with us to be able to put together prospective budgets based off people that we had relationships with that we worked with. And I would all day rather throw a couple $100 down the drain to get a real affirmative stance on a specific deal rather than fly by night and ghost ride into something that could turn into chaos.
100%, man. And you're definitely not throwing that money down the drain either, because you're learning from that, right? It's your experience. Every walkthrough you're doing, you're learning from it, right? So it's 100% worth it. How did you even find the contractor to do the walkthrough with you?
The best contractors I have found personally are from other super successful investors in my given area. Like, for example, you gave me my go-to plumber, Donald Shahini. Like, he is by far...
Shout out to Donald.
Yeah, Donald's a great plumber. Donald's an absolute great plumber. But I literally get my best referrals from the investors that do this day in, day out. Because at the end of the day, how do they scale their business? With good, reliable contractors.
100%, man. And if you come into me and we talk about this, obviously, that if I'm not going to send you someone I'm not happy with, because first thing you're going to do, if that doesn't work out, you'll be like, what the heck happened here? Yep. Why did you even connect me? Mm-hmm. So, even though I'm not making anything from it, I'm just trying to connect two people, but I want that relationship to work. So my reputation is on the line.
And I mean, to add to your point, like, what you hear from new inexperienced investors is like, this is my go-to contractor, I'm not going to share them. Like, that's completely counterintuitive than what you should be thinking, because at the end of the day, if this contractor is serving you well, you want them to stay in business. You want to give them business. Yes. And when you give them business, guess what happens when I call them? They pick up my phone right away and they run to my job. Right? So it's like, it's almost counterintuitive than people think. Is like, you don't want to hoard resources. You want to share resources, because at the end of the day, the abundance is going to flow back to you.
So one other thing that I want to add is that in regards to the contractor question, and this is one of the things that I know he hates, which is having to communicate via text or back and forth with people, not on the phone. So if it's not on the phone, like sending tons of emails or sending tons of text messages, Andrew does not love doing that. He does not like frivolous communication. So
efficiency.
What I will say is I have absolutely no problem with this, and I can sift through all the white noise to get the outcome that I want, and I actually enjoy it. So what I will say is, name me the one place. There is never a shortage of people wanting to tell you their opinion. Where do you find the most opinionated people you could think of?
I don't know. Right now it's online.
Boom. And where?
Facebook?
Yeah, there it is, baby.
There you go.
So if I go
I'm thinking contractor, I'm thinking Home Depot, but I'm like, no, that's
so what I'm going to do is
an easy one.
I'm going to tap into any local community group in a specific demo that I'm interested in, and I'm going to put on blast, hey, who is everybody in town's favorite so-and-so? Favorite handyman, favorite plumber, and I'll tell you what, there is no shortage of boomers looking to talk your ear off about their opinion on the matter than on Facebook, man. You will have 20 recommendations deep in a matter of an hour. And then what you do is you go through and you find the person that was recommended 3 times. You say, hey, this is good enough for 3 people in the local community, right, who have had positive experiences with this person. I'm down to try that out.
What have you guys learned from that experience of raising rents so much, right? Because that's not easy. You go in, buy a building with 3,700, you get the cops called on you. What are you doing differently now?
It is not an easy process. However, the key with it is you don't propose the rent increase, you get the tenant to propose the rent increase. And me and him do that on a normal basis, utilizing the binder strategy. So that's made famous by Dion Talk Financial Freedom. But more or less, the binder strategy is there. You go into the unit, you first have a conversation with the tenant about deficiencies. You're like, is there anything in here I can address to make your experience better? A lot of times it's something cheap like a faucet, a broken window. Me and Zach will pay a couple $100 all day to buy goodwill. And then at that point, we like to establish a verbal contract with our tenants. Like, our expectation up front with landlord-tenant relationship is you pay on time, You treat the unit right, and your expectation from us is we treat you with respect and we address your issues in a timely manner. As long as this is abided by, we're going to have a fantastic relationship. And then at that point, you provide them market rents, like what can I get for that unit? Then you show them their estoppel, right? And then say it's $2,000 market rents. They pay $1,000. We just go to them and we're like, what do you think makes sense? It's literally human nature to choose the 50% mark, right? So they're like, and like, what were you thinking? Like, 1,500. I'm like, that works. So, and then the key there is getting them to propose a solution. Because how many times when somebody proposes a solution, do they not follow through with it? That's just straight weird. So that's how we institute rent increases a lot of times. And it's very successful. I mean, how many times has that failed for us?
So we very minimally deal with eviction. We very minimally deal with very conflict-oriented tenants because we are creating a relationship where it's like, it's not me imposing an outcome on you. It is you and I collaborating together to achieve an outcome that's fair. And I think that there's a couple other points that I'd like to add on to in regards to Andrew is that we preface the whole situation prior with a templated welcome letter. So we go into the whole thing saying we expect electronic payment. Here's some ways in which we're going to be improving the property. Here's how we operate. Here's your point of contact for your lease. Here's your point of contact for maintenance. Here's how you submit a maintenance request, right? And we're going to map out the whole operation. Then we're going to say to them, by the way, we just want to let you know our main objective is we don't want to kick anybody out and we want to work with them, but there will be rent increases that ensue. And we establish that all in a welcome letter. So now going into that first initial meeting, that we've already de-escalated the situation where they're not at fear of being kicked out. Now they're much more willing to work with you and be collaborative. And then we're going into it saying, hey, when we walked the property, here's a whole slew of deficiencies that we noted. We think the prior owner was neglectful or negligent because of these reasons. Here's some of the things that we're aiming to fix on the exterior of the property. But I want to hear from you as an inhabitant, right? What are some issues that you personally are dealing with? And by the way, I also want to hear what you think about all the other people that are living in the building. So what I'm going to hear is I'm going to let this person go on a tangent about Susan downstairs or Jimmy upstairs, and I'm going to hear them out about all their grievances. Yeah. And it also is giving me insight in terms of what I'm walking into. 100%. I also now can figure out, right, what are these things that are sort of really getting under your skin? Mm-hmm. And then I'm also saying, yeah, I'm really hearing you out in terms of, the neglect that existed with the prior owner, so on and so forth. And so one of the things that we establish, which is this is a key performance indicator for us, is we set a very clear standard that in the beginning, when a deficiency is incurred, we want to know about it immediately. And our expectation is to have a vendor on site to analyze the problem in 48 to 72 hours upon receipt of the request. Additionally, it's the expectation that a deficiency is resolved within 10 days of receipt. Now, we track this for all of our properties portfolio-wide, and our team actually will receive bonuses based off of performance. So now this is a mandatory, right, non-negotiable for us. And now when we establish this with tenants, now we don't have that reputation of neglect. And so now what ends up happening is, again, when you walk in and you express, here's the guidelines, here's how we operate, here's the predetermined relationship, here's how we run a professional operation. And by the way, the rent increase, we're not going to make you go down the street and pay fair market rent. We're going to work with you. We're going to be reasonable. And we want to know what you think is the fair amount. If they propose north of the 50% marker, sounds good to me. If they propose below, you just say, hey, that's a little bit below the halfway point. We think that meeting in the middle is probably fair. And there's very little resistance. Correct.
Let's talk about lending, right? I know how you guys started the HELOC, the savings, but then obviously you have had all this growth. So how are you buying the second, third, 10th building now?
So I think you bring up a good point regarding lending. And that brings up another point in the fact that one of our bottlenecks initially in regards to our growth was systems. Me and him, everything was in our head. We didn't really have systems in place, which created a lot of minutia, a lot of extra work. So we actually started building systems. And regarding lending, the system that we built for that was every deal we get under contract, we produce what's called a loan request package. That is everything the lender's looking for. It has the rent roll. It has the schedule of rent increase over a year period. It has the financial tables based off where we're going to get the property in year 1, year 2, and the after repair value based off the cap rate. It has rent. It has comp rent comparables inside there. It has information on me and Zach, right? We put it into a nice, sexy package, and we send it out to 20, 30 lenders. And we literally just let them battle each other in regards to providing us term sheets. And that's how that's how we find all of our lending. And we can get a deal funded probably within 3 to 4 days.
Is it as simple as sending an email saying, hey, we're looking to buy this property, here's all our information, the loan request package and everything you guys put? Or is it a little bit more, anyone that hasn't even tried this, right? Like they know Mutual One here in Natick will do residential loans. How do they even start the conversation?
Well, I think to this point, I think that in residential, they're a lot more stringent on needing to fill out applications and so on and so forth. Yeah. I think that if you are going through commercial, the 3 things that are going to be necessary is they're going to ask you for a debt schedule, they're going to ask you for a personal financial statement, and they're going to ask you for the project at hand. So the loan request package takes care of the project at hand. You have to have your prospective debt schedule put together. You have to have your personal financial statement put together on a template. And if I fire off those 3 things to any lender, I'm not even going to have to deal with any back and forth correspondence. I'm literally just going to get a term sheet in my inbox.
So, Andrew, you're talking about systems, right? I think we obviously want to keep this as real as possible. And obviously that talking about struggles, I'm interested in. What are the struggles you are currently facing, right now at the point you guys are at, but also growing so fast?
The first struggle we dealt with was systematizing all of our relationships. So for our first syndication, and this was our first time raising a lot of capital, like $1.8 million. Zach and I literally reached out to everybody manually for 3 months. It was the most inefficient process. It literally took us 3 months to raise $1.1 million. And by the way, that wasn't enough to close the deal. We had to bring somebody else in to raise the remaining of the capital. We realized our error and our mistake very early on. And right after that, we actually built a CRM to bring in all of our investors, right? And at that point, we systematized in the fact that we created an investor package, right? We created communication. We could send out our deals to 1,000 investors in one foul swoop, right? And our next deal, it was a 32 unit in Lancaster, South Carolina. We raised for that in a weekend? Yeah. We raised $750,000 in a weekend.
$750,000.
Yeah, and in a weekend. And then it took us, prior to that, it took us 3 months to raise $1.1 million. So right there alone, you can see the power in systems, right? And this transition into, a project management software. We started utilizing Smartsheets, rent collection. We do everything through apartments.com for rent collection. We utilize Slack. We have Slack channels for every single property. And that's where we kind of keep track of that. Because, at the end of the day, our limitation is what's in our mind. Like if we keep everything in our mind, we will only scale to a certain point. And I think we realized early on when we systematize things and we make things more efficient, our ability to scale is that much easier.
1,000 people, you said you can send this out, right? Any deal that you guys get. Where are you finding your lenders? Like who are these 1,000 people on the database?
I actually transitioned to, rather than having business cards or handing out my phone number to anybody, I have QR code based business card that has my Instagram, our mailing list, my phone number, my email, everything that was needed to associate with me, as well as headshot. So now any person who I meet at a meetup, my main objective when I go to meetups is how many different people can I connect with? And then can I provide my business card to scan? And then every single time I have them save my contact and then text me on the spot. So then what ends up happening is they text me on the spot. I then leave the event And then I text every single person that I met and say, send me your email. So then they send me their email. I add them to our CRM list. So now every single person that I met at every single meetup is now in our CRM list to be able to utilize for future engagement. And then additionally, I think that the other big one is that Andrew and I got really intentional about guest speaking on podcasts over the last year. So I think that one of the biggest things is like, think about going to a meetup and doing a guest speaking appearance. Great, you reach 50 to 100 people. But if you speak on a podcast, it lives forever and there's indefinite outreach. So effectively, it creates the ability for now more people to come into your network and they're able to learn a whole lot about you without you having to devote your own time to be able to connect with them. And then now they'll follow you and then they'll learn more about you just through organic engagement through social, so that now as time goes along, they already know everything about you before they've even reached out to you to contact. And so now all of these people are in our investor database. We reach out. So it's like, let's say another example is like we go to like BPCon. You meet a whole gander of people at BPCon, add them to your email list. And now it's like we have people who are investors not even from the Northeast that would be investing in our deals who are, used to operating in different markets, but they either met, myself or Andrew or whatever at an event. And now those people are reaching out, through our channel.
Yeah, and I mean, just to add to that point, I mean, I think you utilize a similar strategies. We do a monthly newsletter, right? And we try to funnel as many people to our monthly newsletter. And our newsletter doesn't only talk about deals; it provides them value. It provides them a ton of value in the form of off-market deals, in the form of best practices, in the form of news articles, right? In the form of just telling our tale. Right? So we get people on our newsletter, which is incredibly powerful. And the one single thing that has helped our capital raise immensely is systematizing getting people resources. So we actually made a standard operating procedure for our virtual assistant to say every time we put somebody in our database, they send them a whole bunch of resources of deals we've done, kind of information about us. And it's just a standard email template. Literally about 50% of the people that get that email love the content. I get a response back, I love this, thanks for this information. So that alone, like that one thing.
Value add.
Yeah. And then what ends up happening is they get bios on me and him. Now each month they're seeing monthly updates on the deals that we're executing, where we are in the process. And we're being super transparent about like, hey, this deal, could be going better for these reasons. Hey, this deal's crushing it. Hey, we just finished this one and we're giving this amount of money back to investors. Like we're putting quantifiable metrics in there saying literally this person invested $100,000 a year ago and this is what they're getting back. Like it's really tangible and digestible for somebody who's new. And the thing is that at this point, we have on our newsletter, we have a 70% open rate.
That's crazy. How did you end up on the Bigger Pockets podcast twice? What's the strategy there? Because, I want to talk about that briefly and then the social media, because even on social media, you guys post a ton. You provide value through the videos. But also sometimes your opponents, you say, hey, we're looking for investors, right? For lenders. Tell me about that. How did you really end up on the podcast with Bigger Pockets first?
So I applied to the Bigger Pockets podcast a good 3 or 4 times.
Got it.
Crickets. Didn't hear a thing, right? But I do host one of the largest real estate meetups in Worcester. Yeah. I ended up having a guest speaker, Jesse Dillon, at our meetup. And after that, I told him, like, it's always been my dream to be in the Bigger Pockets podcast. And she's like, oh, let me introduce you to one of the producers, right?
There you go.
And then at that point, honestly, I was in the right place at the right time. Bigger Pockets was really trying to push at that point, keeping your W-2 while scaling your real estate portfolio. And that's exactly what I did. I had my W-2 while I had around 24 units. So I matched the narrative that they wanted to display at that particular time. They brought me on. It went very, very well. And then at that point, since that BP podcast came on, after that, I closed on over 100 units, right? And I think the key here is you got to ask for what you want. So at that point, I reached back out to them like, hey, since the last time I've been on the Bigger Pockets podcast, I've closed on 100 units. Would you want me to get back on and tell my tale? And that's exactly what happened. They got me back on and I came on a second time and it was kind of history from there. And then from that point, that's when I realized the power of podcasts, because I released that podcast right before our first syndication deal in New Bedford. And we were able to raise $1.1 million. And I'm like, wow, podcasts are really powerful for building a reputation, building trust. And that's when I started to kind of trying to get on more and more podcasts.
Andrew, how's social media has helped you, and in what way?
Yeah, I mean, at the end of the day, like I'm as introverted as you get. Like when it comes to our business structure, like I'm very much the integrator. He's very much the visionary. I'm very much the numbers guy. He's very much the salesman, right? But the more you do something, the better and better and better you get at it. And that's exactly what I did. But my main objective when it came to social media was provide as much value to the world and expect nothing in return. Because at the end of the day, people don't like to be sold anything. And if you're not trying to sell anybody anything, if you're just trying to provide value, people can see through that, right? And that's exactly all I've tried to do since I've started social media. And in regards to social media, you got to be consistent. You got to do it day in and day out. Like my goal was to post like 5 times a week because, the more consistent you are, the more success you're going to get. So that's kind of been my strategy with social media. And it took a good 2 years before I had any traction. I got 2 years of just 1-2 likes, right? But, I stayed consistent. I kept my eye on the prize, and now it's kind of blossomed into something kind of bigger than I've ever expected.
So let's wrap this up. How can people follow you? How can they get in touch?
They can find me at Investor Freed and Andrew Freed on Facebook.
They can follow me on Instagram at the 1099 Mindset, and on Facebook just by my name, Zach Gray, Zach with a K, ZACK.
Awesome. Guys, this has been awesome. We got more content to share and more tips to give. We got to head out to the meetup. So if you guys are watching, come join us at the meetup events. It's once a month here in Natick. And come meet guys like Zach and Andrew and network and hang out with us. Guys, thanks for being here tonight, man.
Thank you.
Awesome. Appreciate it.
Thank you.
So that's a wrap. I had a great interview with Zach and Andrew. I learned a ton from these interviews, and honestly, I'm always taking away actionable steps. I hope you guys feel the same. If that's the case, like this, subscribe, share, right? And comment below. I would love to hear from you guys, the takeaways. I would love to hear what your plans are in real estate investing. And let me know who else would you like to see here at the meetup. And who else would you like to see here at the interviews? Help me get to 1,000 subscribers, so please subscribe, do me a favor. And if you guys are local, I highly recommend that you join us for the meetup events. These are great opportunities to find partners, for you guys to find deals, to find capital, and just to come and say hi, right? Come and network with highly successful people, but also like-minded people. So hopefully I can see you there in person. Link below to sign up. Catch you guys in the next one.